Let's move on and talk about all this money and the flooding into the U.S. and the government has really pumped into the market. Inflation in the U.S. now a concern, and bond traders are also pricing it into their trades, and that could mean higher interest rates. Let's turn to Michelle McQuarrie now with an update and an outlook on the bond markets. Michelle?
Hi there, Susan. Well, the recession has been good for Treasury investors. In fact, government debt posted the biggest returns since 1995 last year as investors piled into Treasuries to flee riskier assets. But the bond bull run is now over. At least that's according to Paul McCulley. He's a portfolio manager and partner at PIMCO, which is the world's biggest manager of bond funds.
We have to face reality is that we're at the bottom of a secular bull market in bonds, and I think it would be a protracted bottom. But the big gains to be made in bonds, quite frankly, in our lifetime, notably in Treasury bonds, have been made.
And as bond yields rise, bond prices fall, and as goes inflation, so go bond yields. So where is inflation going? Well, if you take a look at this chart, it shows the two-year note, the yield of the two-year note. That's the white line. And as you can see, that follows very closely the trend of inflation. That is the blue line, inflation measured by the Consumer Price Index. And the slightly more transparent lines show where Bloomberg economists think that the CPI will go. So that's the blue line over there. And as you can see, the two-year Treasury yield following that trend upwards. And that CPI forecast based on a median of over 60 economists surveyed by Bloomberg. So we can see that the yield curve will head up, meaning bond prices will head down. And that does support what McCulley is saying. Susan?
Yep, that's one scenario, Michelle. But let's say the recovery takes longer and inflation stays low, then what?
Well, if you take a look at what the TIPS tell us now, the TIPS Treasury Inflation Protection Securities, and if we look at the difference in the yield between the two-year note and the two-year TIP, that is what the market expects for inflation over the next 2 years. That's what we call the break-even point. And right now, that is predicting inflation of 0.25%. That is a lot less than 2%, what most of the economists forecast. The market and the economists not always on the same page, but it nevertheless is still higher than inflation now, which is a minus 2.1%, and it still suggests higher yield. And if inflation is rising, so will bond yields, and prices will then drop. So really, Susan, it's just a question of when. Back to you.
Okay. 0.25% doesn't sound that high in inflation terms. But thank you for that update, Michelle. Michelle McQuarrie in New York on the bond market.